Yes, here we are. Welcome to Thursday, Zach. I'm Zach Strickland, head of market intelligence at FreightWaves. Tony Mulvey, a lot of things involving economics and research. So, you know, the show today, of course, as I wake up out of my stupor, is about how much optimism has returned to both the economy and the transportation service provider perspective. And we're going to discuss today about whether or not that is warranted.
Yeah, it's starting to, you're starting to see signs that executive management teams are more optimistic than they were a few weeks ago when they were releasing earnings, which is interesting because normally you wouldn't, that quick of a turnaround, you wouldn't see the hope and optimism start shining through. I mean, I think they have to present that face to some degree to not have their stock sell off. But I think there's some level of the optimism may be warranted to some degree.
Well, I mean, I look at some of the freight market data and it tells us that it absolutely is warranted because there's almost nowhere to go but up.
Yeah, well, yes. And we've kind of been in that situation now for a while. And it was always a matter of, all right, how long can we stay at the bottom? Because it can't go lower. I mean, we've talked about rejection rates and they effectively have a natural floor, right? There will always be imbalances of capacity.
They can only go to zero.
Well, even then, it's like odds of them going to zero. I mean, even during the COVID like lockdown period, they didn't go. They were close.
Natural inefficiency.
Yeah, I mean, there's always going to be imbalances of supply and demand throughout the country. So there will always be loads rejected. So the question was always going to be, when do we start showing signs of coming off of a bottom?
Right.
And you're starting to see outside like market influences have a larger influence on the market.
Yeah.
I think last week was a prime example.
And I think the economy is a little bit more tricky.
Yes.
That one still seems noisy to me. Like I know there's certain economists out there that I follow and respect that really have a good argument that we're actually somewhat in a recessive environment already.
Yeah.
Like the economy isn't as strong as some of these aggregated figures might suggest. And I think depending on your industry and sector, I mean, transportation is the epitome of, hey, we are extremely disconnected in transportation from the rest of the economy.
Yeah. I mean, and then
in terms of aggregate numbers.
Yeah. Economy, everybody points to the stock market as a gauge for like where people think it's so disconnected because you're closing at record highs.
Yeah.
And like it seems like it shouldn't make sense when you go back and start looking at GDP growth has been slowing for 3 consecutive quarters. Like we shouldn't be going up. Like we're in this downward trend or slowing trend and everything else continues to like go up and people are optimistic and momentum is upwards.
Momentum is a thing.
It's hard to stop positive momentum and because it's mindset, it's things like that. It's not, you start to see disconnects from some fundamentals. And what's interesting about this optimism from the transportation sector is it's rooted in fundamentals to some degree, as opposed to just riding positive momentum.
Well, let's get down to it and look at some of this data. If you want to count me in for the market in 2.
Zach, you'll start in 3, 2, 1.
All right. Starting things off with our tender rejection index. This is the most boring yet most important index from what I can tell over the last bit. If you're looking at this index, that white line is the current year's rejection rate. It's still under 5%, but you can see that nice little uptick in the tender rejection index, and it's strong. It's much stronger than it was this time last year. We just had Road Check Week. Normally, Road Check Week gets a lot of press, a lot of noise around it, but it's kind of a small operator type thing because it's owner operators that choose to sit. Larger fleets are operating throughout Road Check Week. They're up to code in most cases, and it doesn't really necessarily influence this. But A little bit of Memorial Day influence as well, I think, going on here. Rejection rates coming up close to 5% this year, and Memorial Day at that is still news, even though this is still, if you can see from the COVID perspective in 22 and 21 there, orange and green, we're still historically low and a rate deflationary environment. If we go to the next chart here, we will then progress to the next one. And this is going to be the map of the weighted rejection index. And what this is just a combination of weekly change in rejection rate by market combined with market share. Out west, look at California, Ontario. Rejection rates increasing more significantly out there than most places in the country, but there's a lot of blue on this map showing increasing rejection rates in a lot of spots. Houston, over there in the eastern part of Texas, and strangely Denver, places to watch. We go to the next one. We look at a breakdown of the rejection rate by mode, van, refrigerated, and flat. Flat, of course, still leading the way here. Elevated rejection rates, it's trending higher too, staying on a stable path. Rejection rates for refrigerated really sharply upturning here. Van also moving higher, but not as strongly and sharply as reefer. And Tony, we talked about the refrigerated sector before the show. This is an interesting time of year for refrigerated, so definitely something to watch.
Yeah, it is. So I mean, you've got this combination. The reefer market particularly is impacted by produce, and we're May 23rd, so almost to June. You should start. I mean, produce markets and produce producing markets are starting to move further north, right? It's not Southern California; it's all year round. You're out of southern Florida, really, in central Florida. You're starting to move up into the southern parts of Georgia. And you've been seeing that for a while. You've seen rejection rates around the Savannah, the Macons, the Tifton. The markets that don't, outside of Savannah, don't get a lot of press typically. You've seen rejection rates trending higher recently. What's interesting is you don't see volumes have grown really since the beginning of April in the reefer side. But they're basically in line with where they were in March. So not really the substantial uptick in contracted reefer volumes, but you've seen the reaction in rejection rates. Well, there's nuances around produce, typically direct to spot because there's short lead times. Hey, we need your truck tomorrow. Well, carrier is going to, if they have the option for a higher paying produce lane or load versus a contract load where that rate has been deflated so much over the past year, they're going to take that. And you're seeing it. That's why you're seeing rejection rates partially pick up. Now, granted, historically low, sub 10%, but you also have influences. Reefer naturally has longer lead times too. We're 2 days from Memorial Day weekend. You come off road check week, you typically have 4 or 5 day lead times on the reefer side. So it's like an instant impact that the holiday has. They flow together, which is part of the reason why you're seeing maybe a much more aggressive uptick in the reefer market. And it's smaller. You should see more disruption happen maybe faster than what you see it in the van market.
Yeah, it's less dense, less sample size, so it's easier to knock that percentage up faster. But also, it doesn't take a lot to move a rejection rate from 3 to 4%. Anyway, that is definitely a thing. I also want to show the spot rate chart the spot rate map for the United States, I think, van here. So we're releasing this here in the next couple of weeks, if not today, because I'm just now talking about it. This is a heat map of where rates are increasing the most significantly for dry van. And you can see, look at this rate map, Tony. I didn't show the aggregated NTI or FTI or RTI here, but this is showing dry van loads. Anything in dark blue is actually going up.
Yeah.
So the majority of the markets are showing more lanes increasing than decreasing for dry van. We've actually got some downturns in the Pacific Northwest there showing up. And that makes sense.
Yes. You want to, you're at this point, you're trying to exit out of, and you see it in Maine, right? I mean, you're trying to exit out of these markets where freight is limited. You're trying to get a backhaul where you're making some sort of money,
and they don't live there.
Yeah.
So
also
they're trying to go home or take vacations. They're trying to get out of there. And I want to show the, if we have it, the refrigerated version of this, the reefer map, which we have. This one's fascinating to me because you can see the Pacific Northwest is dark blue. Southeast is pretty blue. into itself. But everything in the Midwest there in the central part of the Dakotas, obviously, same situation though. Like,
Yeah.
get me out of the Dakotas and move me somewhere else.
It makes sense. And I think what's interesting is we saw the weighted rejection index, and you start thinking about timing of the market. It's carriers don't, I mean, there is quite a few that live and drivers that live in California, but the ones that don't aren't willing to go out there over Memorial Day weekend, and it starves the market of capacity.
Yep.
Because you have, as you've alluded to it, the desert between Dallas and LA, that there's not much there that you've got to traverse to get out there and then come back. I mean, you're giving up a week. And if you didn't go out there last week, you're definitely not going out there this week with the holiday. So you're trying to stay maybe closer to home and take freight there. It starves LA, and you see it really on the reefer side.
Yeah.
Really a substantial uptick, and you're seeing it actually impact spot rates on the reefer side as well.
Yeah, I think this is also, this kind of feeds into that hopium in the market too. Like, we really haven't seen this level of significant increase, around Memorial Day for a couple of years now. Yeah. You looked at the tender rejection index, it was pretty flat, if not on a downward trend. Yeah. 2022, 2023. This level of responsiveness. I want to pull up one more chart, the FTI and RTI and NTI chart. If we can pull that one up. It was right before the map series here. Yeah, here we go. And you can see you got NTI on the bottom. Well, that's dry van centric. That's the white line, or the yellowish line. And then you got refrigerated there in the bluish. And then you got flatbed spot rates for the nation and the big mountain. Yeah. We talked about it with rejection rates. Flatbed markets, definitely the most easily disrupted at this point in time. The spot market for flatbed really never cooled off like it did for the others. Refrigerated had a section of the year there, spring, where there was really no activity after having a pretty strong fall last year. And then winter, we had that January freeze event that got that market a little hopped up, but the van hasn't been that as responsive, but it's starting to show some real strong sensitivity.
Yeah, I mean, if you looked at last year, same time, because International Road Check Week was roughly the same time, maybe a little.
Generally around the same time every year.
It's right around mid-May. Yeah. Right? So if you would have put this chart year over year, you would have seen two very different reactions in the van market. Yep. I think why you see flatbed being boosted is flatbeds tends to be a lot of project freight. Yep. Thus, shorter lead times, more weather dependent because you've got construction projects and things like that. Summer months, warmer weather creates this opportunity. Things move more via flatbed during the summer than they do in the winter months. So I think that's part of the reason you're seeing this uptick. I think the reefer side, I think it's a combination of a lot of things all happening at one time. Because what was just 2 weeks ago, 2 weekends now, Mother's Day, which flowers, right? Then you have Road Check Week, the immediate week after that. Right. And then the week after that, you have Memorial Day. Like, it's like three things right in a row. That's like, so to me, you have those outside influences to some, we can call Road Check Week an outside influence only for the perspective of it is something that is not just supply demand related, right? Like, it has impacts, but it's from outside sources. Right. They're having a bigger impact now than what they had been having. And I think that's the key takeaway, is where this hopium comes into play, is these outside influences are being more impactful than what they were this time last year, which we saw as the year progressed last year, they became more and more impactful compared to what they were. So if this continues, it sets up the back half to be more disrupted from things like the holidays, right? Look at Thanksgiving, this Q4. If there is, say the consumer is actually in a better place than what you kind of look at some of what the economic side suggests, like if it ends up being in a better place and they continue to spend through the holidays, like guess what? It's going to, demand will increase. You're already being a capacity situation that's being influenced heavily or being more impacted by these outside influences. It sets up a market that can be fairly fragile.
Yeah.
Come that fourth quarter.
Well, we know that capacity is still leaving the market.
Yeah.
And it's not leaving in droves like it did in 2019, according to some anecdotal stuff, but it is leaving. I mean, it is actually leaving at a faster pace than it did in 2019, but it's also coming from a mountain that was much higher.
And it's coming from smaller operators, right? You have to remember, like, all the growth that you largely saw was in smaller fleets and not, I mean, in 2019, we saw Celadon go under. I mean, there were a bunch of fairly large bankruptcies. And I mean, you're starting to see more and more arise and that are larger than, the one truck fleet.
For sure.
But it takes a while to churn
that much
the amount of excess and just the smaller guys, because at the end of the day, they took a risk, and for them to leave is basically admitting that it was a failed risk.
It's that is one of the hardest things to do, is kind of cut your losses and move on. I forget what it's called in psychology, but you get it in gambling. Where you basically double down, the stop loss effect or something like that, where you can't, like, you feel like cutting your losses is too much. So you don't want to lose more. But you're willing to stay in it because that admits that you're not going to recover anything. And that's hard to do. So, they had a conference this week, transitioned to the news of the day. This really, validates a lot of what we're talking about here. We had Todd Maiden wrote this article, Truckload Carriers Hopeful But Not Calling Cycle Turn Yet. Again, hopeful being the key word. Derek Leathers, Schneider CEO, was here at this conference, and Mark Rourke, Schneider Nationals president and CEO, also at this conference up there. And really what they said, and I think there's a few quotes here that really stand out to me, Tony, and by no means am I here saying I think we're at a turning point or an inflection point, but I do believe, just like it took a long time to get this low, and we stayed this low for this long, it's taken us a while to maybe pick up on some of the signals that are out there in front of us that seem to be more positive. Derek Leathers, CEO. He's not saying that the market has turned or flipped, but all he's saying is that there's some signs that we're approaching it.
I mean, if you start looking at it, and Todd talks about it in the article, I mean, it says Derek's company, Werner's seeing price renewals move higher, but not across the board, right? Like, and I think that's the key, is why you're seeing that. I think it's from a shipper perspective, is they've gotten a lot of them, especially the more savvy shippers, have already recognized that they've gotten all their cost cuts from transportation. Now they're going to prioritize service. And that prioritization,
or they should prioritize service.
And yes, exactly. That should be where it moves to. And this makes it, that kind of idea that they're seeing renewals slightly higher, to me says, hey, as long as you service the freight, we will continue to do these things. I think it's less churn, but I think what's interesting is that it goes further. It talks about this improved bid compliance from previously ordered freight. I think that's from the shipper perspective, actually honoring their bid, as opposed to moving to the spot market. So I think that's where the service comes in. They understand that, hey, maybe we shouldn't push this into the spot market.
So
they're pulling that spot market freight back into their contract. For service. That would be the only reason they would do it, right? So I think that's a big key takeaway, is like some of these more savvy shippers are now shifting their mindset from cost savings to service prioritization.
I mean, at least they should. I know that there has been a lot of, there's still like those out there that are really targeting that cost reduction. I mean, all these companies, especially in, transportation isn't their business.
No.
So they read the GDP numbers and they say, well, everybody's doing okay. So, hey, transportation manager, go get me some more cost savings. You got me 10% last year. Carry this momentum forward for me. And that's blind to the underlying dynamics of the transportation environment right now. And you can't blame them, because that's not their lane. That's not their job.
I mean, at the end of the day, that it's a line item on a spreadsheet, right? It sounds bad to say it that way, but it is. And it's one that if we can reduce costs, it boosts the bottom line directly. And the problem is when you start cutting it too much into the bone, it sets up what we saw in, the COVID cycle. Maybe not as extreme, but it does happen where those costs very quickly balloon. And if you can't grow your top line faster than what that transportation cost is rising, it squeezes your margins very quickly.
Right.
And I think that's the key takeaway is like, look, if you actually dig in or trust if your transportation manager is paying attention and understands like where kind of the market dynamics are in the current environment, I would listen to them.
At this point in time, you're only going to do them a favor. Like what we're talking about here. So, I want to, Leathers kind of ends up with a quote or a statement, I should say, that most spot freight is on load boards and not reflective of the drop trailer and other engineered solutions the big carriers offer. So the spot market itself is really not a great measure of that contract. Large carrier, larger shipper, most of the freight movement in the United States' environment. As such, he doesn't think contract rates need to reset lower than spot rates. And if we move to the next story, so I wrote a chart of the week, just this past weekend, not having read this article because it didn't come out until this week, but historic trucking rate disparity could cripple service in late 24. The whole point of this article is exactly what Leathers is talking about here. Is, listen, this is the contract and white line there you're looking at, and spot market rate, or the spot rate for dry van loads, excluding a comparable amount of fuel surcharge, or comparable amount of fuel cost to a fuel surcharge. And you can see spot rates have been super low compared to contract rates. And when I say contract rates, these are long-term, 12-month, big shipper, big carrier biased invoice data that we have here at FreightWaves. That spot market freight is, broker freight. It's out there being handled by 3PLs, and it's super low, and it's overweighted with this desperation, like rate.
Yeah.
And it's so low that it's, for contracts you can see they're leveling out. They're not going to go lower.
Yeah.
Like the spot market is utilization freight. It is below cost in most cases. Carriers cannot live in that world with too much of that mix.
Yeah. And the problem is, if you look back historically, like you've seen, look at 2018, that market cycle, granted, the flip in that was caused by an outside influence.
Yeah. Most of them are.
Yes. Spot rates didn't, for that cycle to turn, they didn't cause this like flip, right? Like they didn't have to be repriced higher. Eventually they did. Right. And you see that where the market inflects. But you see a sharp move in spot rates followed by the move in contract rates. And it was just how the market dynamics were working. But I think just this gap in between, the narrower they move, the more it's going to feel like the market's shifting.
Yeah.
Because
and most of the freight, and Rob Haddock told me to mention this when I talk about this type of stuff. Most of the freight in the United States moves under contract.
Yeah.
That is the bulk of it. The spot freight is not, it's not sustainable. It's ad hoc. Why would you negotiate that much freight on a daily basis?
Yeah.
You wouldn't. I think roughly somewhere around 70%, 60 to 70% of the volume of freight in the country moves under some form of a long-term contract rate agreement. But the spot market is a leading indicator. It's a near-term indicator because it is negotiated that day.
Yeah.
If you look at this chart, it's moving higher. The spot market is trending higher, but that gap is so wide.
Yeah, it's hard to see it.
Yeah.
But if you go and look at rejection rates, because I think rejection rates even lead where spot rates are going.
Absolutely.
I went back and looked at the last since the rejection rate started back in 2018. If you start looking, they bottomed out in the second quarter of last year and have moved up. The quarterly average has increased each quarter after quarter since then.
Right.
Even the first quarter was higher sequentially, which is crazy to say that the first quarter sequentially rejection rate was higher than the fourth quarter, but it was. And to me, that is a signal that slowly but surely the market is moving back more into not just equilibrium, but in a place where you're going to see disruptions appear a lot easier than what they were.
Absolutely. And these
just a few years ago.
So these rate data points though are telling you this cycle is coming to an end.
Yeah.
It may not be this month, it may not be next month,
Yeah.
but it's closing. That window's closing. And in 2017, we had Hurricane Harvey that really triggered the cascade.
Yeah.
Produce season 2 had an influence in June, but it was like these two events kind of gave that early warning sign that, hey, but that was a supply side correction, just like we're seeing right now. And it's ongoing, and it's only a matter of time. So if you are, out there looking for risk management for your transportation in the fourth quarter, now's the time to take care of it.
Absolutely, because if you don't, you will be left dealing with market dynamics, whatever they are. So,
well, hey, we have an event in 2 weeks.
Yeah, and we're going to have 2 shows.
Two shows.
Yeah, so if you don't have your ticket, go on, use code Freightonomics FSC24. Get your tickets for Future Supply Chain. Me and Zach will be there.
Yeah, we'll be there. Welcome to see me on stage.
Yeah, we'll be up there.
I'll be up there a lot debating and the whole debacle. But in the meantime, have a great week.